You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is 12/21/2020, the winter solstice. And on that note, markets are down, purportedly on a new strain of COVID originating in the UK. They say they've isolated it, and that's just the news that nobody wanted to hear. But what do you expect? And you shouldn't be surprised by anything that happens now, which is why we're doing what we do. Well, where are precious metals markets heading? That's what I keep getting the preponderance of questions about when you email me at KL@Kerry Lutz. So we decided to get Jordan Roy Byrne on with us now, thedailygold.com, and make sure you get his new book, The Coming New Bull Market in Gold: Why Precious Metals Investments Will Flourish in the 2020s and 2030s. Jordan, welcome back to the show, and it's great to have you back on. So metals prices, that's what's on everybody's mind. What's your take on what we're going through right now?
Well, with respect to precious metals, my general view is the correction is over, and it looks like it ended at the very end of November. And we've seen a somewhat decent rebound. And my view is, as we move into 2021, that gold and silver should be able to work their way back to those August highs. I don't know if that's going to take a couple months or longer than that. I think it's probably going to be a grind higher. It's not going to be like we saw over the summer. So that's my general view. I mean, there's some interesting cross currents going on. I mean, the dollar is coming down really, really close to strong support at 88. So the dollar is something in the new year we could see a counter trend bounce there. That's something to keep an eye on. And at the same time, perhaps a counter trend bounce in the dollar could hit the stock market and coincide with a correction in the stock market. So those are some cross currents that I'm considering, in addition to the fact that we have put in these lows in the metals and that the path of least resistance moving forward is going to be higher, but I wouldn't expect some massive move higher over the next couple months.
So you think basically it's just more of the same, huh?
More of the same in terms of what we've seen in the last 2 or 3 weeks as far as a rebound, probably a grind back higher. But as far as more of the same, we have to keep those cross currents in mind of a potential rebound in the dollar, and the stock market is getting really overheated in terms of sentiment. The numbers there are at real extremes. And I don't think the stock market is at a major risk yet. But I will mention this regarding the stock market. I mean, the best comparison for where we are is the 1960s, 1970s, that period. But it's really the mid to late 1960s right now. And when the stock market made its peak in the 60s in real terms and commodities really started to lead, that was when inflation broke out. And if we're looking at the CPI has been trending down for about 30 years. And so if that were to break above, I don't know exactly where the mark is, but if we see the CPI break above 3% and get into the 3.5%, 4% range, I don't know when that's going to happen, but my view on the stock market is when that happens, I think that's when you're going to see the stock market come under pressure. I don't think it's going to be like a deflationary crash, which everybody predicts. I think it's the opposite. It'll be what happened in the mid to late 60s when inflation started breaking out and then it hit corporations across the board. So that's, with respect to the stock market, that's my view. And I don't know, maybe it'll happen next year, maybe it'll happen the year after, but that's what I'm looking at as far as the stock market. When inflation starts to break higher and become a problem, that's when the stock market is basically going to be a bad investment moving forward.
Interesting. So you're really thinking that major inflation is going to rear its ugly head, huh?
Yeah, I do see that. And again, the timing of exactly when that will happen, I mean, it's already rearing its ugly head for many people, unfortunately. But I think, and obviously the economic indicators are kind of lagging. So inflation will already be a problem before we see it reflected in the CPI. But I think the way things are set up, I just think there's no way around inflation becoming a problem. And I don't know, maybe it won't really hit the markets hard until the following year, 2022. But I think it's something to keep in mind. And if you look at what's going on in the bond market, longer term yields are ticking up a little bit. The markets, I mean, what we've seen in the last quarter or two, the markets are now anticipating higher inflation. And I think that's something that's probably going to continue across the board. I mean, I think once, I'm not an epidemiologist, but viruses, it seems like they burn out at a certain point when there's herd immunity. And so you have that, it's probably going to start to burn out when people are going to get vaccinated. So I think you look at that, and I don't know if that's 6 months away or 5 months or whatever, but sometime probably before the summer, I think, the worst of the virus and all that will be over. And, a lot of people have been staying at home and they've not been spending money. And the government and the authorities are obviously going to pump in lots of money, and especially on the fiscal side. I think if you look at the population is in favor of fiscal support, regardless of whether you lean left or right or center.
Yeah, it's universal. And no one's turning away.
Universal.
Yeah, no one's turning away government money, right?
Right. And so I see, and so you're going to see a natural boomerang effect from everybody staying home. People are not spending money, or people are spending less money, to the virus will burn itself out as far as herd immunity, and then people are getting vaccinated. And people have saved more money. Savings has been going up during this period. So what I'm getting at is when we get to the other side, which will be potentially the second half of this coming year, you're just going to have a lot of money going into the economy. A lot of money is going to be spent. You have the 0% rates, fiscal support coming. So I think that's going to set off you're going to get a combination of a good bounce back in growth, but you're also going to get high inflation. So I think that's going to be the story over the next year or two.
And when we talk about inflation, there's different definitions. Your definition centers around higher consumer prices, correct?
Correct. And I'm just looking at the trend of the data and the statistics. I know that they underreport inflation. I mean, we've talked about that for years and years. I mean, it's BS, but with these statistics, look at the shape of the curve, look at the trend lines and the way they're trending. Because if you look at shadow stats, it trends the same way as the CPI. It's just at a higher level, and maybe it trends up a little more aggressively, but the curves are very similar. So when you look at the CPI, that's what I'm focused on. The fact that it's been, yes, it is a somewhat fraudulent statistic, but it's been trending down for 30 years, basically. And if we see that turn up and break that downtrend pretty aggressively, I mean, that's a signal that you can rely on a lot more so than the nominal level that it's at.
Yeah, exactly. It might be a lousy statistic, but it's our lousy statistic, right?
Right.
Yeah. So, and yeah, it's understated. We know all that. Just like the unemployment rate is understated, got U1 through U6, and then underemployment, which is rampant, which never is properly calculated in the numbers. But like you said, that's all we have to go on. We don't really have much else other than everything else being anecdotal evidence. So it's a little bit better than anecdotal evidence. But Jordan, when you see like the number of restaurants, small businesses, they've just been decimated by the reaction to the novel coronavirus. And how are these people coming back? Who's going to start a business? Is the government just going to give people money to start new businesses? Is that what we're going to devolve into?
I think it's quite possible, honestly. But what's interesting, Kerry, is, and you look at the markets, and there's people who've been saying this is going to be deflationary. There's massive bankruptcies, and I agree with that. It makes a lot of sense. However, if you look at the markets, you look at what commodity prices are doing, you look at emerging markets, you look at stock markets, You look at long-term yields, and inflation expectations are starting to trend higher. So you always have to look at the markets and look at what's going on and kind of try and marry the two together. And so sadly, small businesses having to close and go bankrupt and all that, it's just not having the markets are telling us like that's not going to pull the economy into, some spiraling deflationary depression. What the markets are saying is no, the worries the other end is going to be on the inflationary side. So and leading back to what you posited there, it's very possible that the government will give people loans like they did earlier this year, but perhaps on an even more massive scale.
That's frightening, but a lot of people didn't get the loans. They could have gotten them. Maybe not the first batch, but the second round of them, anyone could have gotten. And it was just the intimidation factor, the discomfort factor of asking the government for money when you never borrowed any money from them in the past. That's a difficult pill for people to swallow. So we go back to the kind of Will Rogers school of investing when he once jokingly said, I'm investing in inflation. It's the only thing going up.
Yeah, I mean, pretty much. But in addition to that, I would say the times when commodity prices do well, you have higher inflation, emerging markets tend to perform better. So on the more conventional side, I really like emerging markets. I mean, if you look at a chart of, I think it's EEM, all right, that includes, that's a total return chart. That includes the dividend, but it's either that or the one that's price only that's coming up, or it's trading around 12 or 13 year resistance. So moving forward, like if you just had to dollar cost average into something, I would prefer that and possibly some small cap value to go with it. Small cap value's had a really good run in the last several months, but before that, small cap value is at a level where the projected return going forward was probably around 10% a year for 10 years. So that's been my thought. If you had to invest in something that's more, and hold it for 10 years or dollar cost average into it, I would lean towards small cap value and also emerging markets. On the conventional side, that's really, I think those are going to be the best performers moving forward. And if you look at our stock market and our bond market, I think it's going to be a very tough row to hoe over the next 10 years. I mean, going back to the late 60s, the mid to late 60s, Kerry, when you had a breakout, you had a mini breakout in inflation in 1965, and then you had a much larger breakout in late 1968, early 1969. If you just go back to the mid 60s, that breakout in 65, over the next 10 years, the stock market had three bear markets. I think one was 36%, one was more mild, 22%, and then there was the big one, I think in 73. Which was about 50%.
I remember it well.
So that's three. You had three after inflation made that mini breakout. You had three bear markets in 10 years, and so it's the potential going forward. Like you absolutely do not want to be holding U.S. assets for a long period of time. I mean, maybe if there's a big bear market, maybe you buy at the bottom and you could hold it for a couple of years. And there's a really good rebound. But U.S. assets, we just cannot own those over a long period of time right now. It's not the time to get in. You have to wait till, after a 50% bear market or a 40% bear market. And you just have to wait till the valuations and the long-term return potential looks a lot better because it's not looking good right now for the next decade.
All right. I've got a key question for you. I've asked many people this question and I get different answers from different people. So copper prices, they've been just so strong, strongest metal of any, and the base metal group too, for that matter, but especially copper. And it's heading towards $4 a pound. We need higher copper prices. The best cure for higher prices is higher prices, or best cure for low prices is low prices, as the saying goes. But here's the thing. I can't get an answer on it, and I don't think anybody knows, so give it a crack. Are copper prices going up because Dr. Copper says the economy is getting better, or are copper prices going up because inflation, commodity price inflation, which we don't see in consumer prices for a good 6 months to a year, is it perhaps possible that we're experiencing commodity price inflation? Guess that was a long-winded way to ask you, are commodity prices going up, Jordan, because of monetary and fiscal policy? You know, we've got so much liquidity in the market, and people say, well, copper, man, that's like underpriced more so than gold, or was more so than gold or silver. What's your take on this?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
I think it's actually both. I'll explain why, but I think it's more a function of the inflation expectations picking up. But I think on the growth side, getting back to I think it was my previous answer, we are going to have a lot of money hitting the economy at some point this year. And you kind of get that boomerang effect, because I don't know about you, but I'm looking forward to traveling again.
Oh, yeah.
When things open up. So I think, I'm not to say the economy's great and, gloss over all the terrible things that are happening and the poverty and the suffering, but just looking at the economy and what's going to happen when we start to open things up and the virus, we get herd immunity and people are getting vaccinated. And so the virus kind of fades out. You're going to have a lot of money hitting the economy. And so that's growth. I'm not saying that's going to be permanent. We're going to have this fantastic expansion, but we are going to have a pop in growth probably in the second half of this coming year. And maybe that'll last a year or two. So I think the market is looking at that in addition to the inflationary side. So I think that explains copper. I mean, I'm surprised that copper was able to move above right around 330. You had resistance there going back about 6 years. So I was expecting a correction there, but copper has moved above that. It's trading at 358 as we're speaking, but I see resistance at right around 375, 390. So there's stiff resistance in that area. So I think at some point we could see a pullback in copper, but I don't think at this point you're going to see like a big leg down or some massive correction. I mean, I'm really surprised how much that's moved. But again, Kerry, it goes back to, this is what the market is telling us. It's anticipating inflation and some growth actually, but I lean more towards the inflation side.
All right. Finally, I got an answer that I like, because I just don't buy the growth equation. I mean, maybe I'm wrong. Maybe I'm just Mr. Pessimistic. God knows if you talk to my ex-wife, she thinks that. But the fact of the matter is here, it's just, I don't see this massive economic surge. Now, maybe they're going to start all this infrastructure stuff. Hallelujah. But I'm just not sure, which just means more debt anyway, which means more inflation, no matter how you cut it. Inflation, price increases in commodities and in consumer prices are baked in the cake.
Exactly. But I mean, to get back, not to disagree with you entirely, because I think at the root of the issue, you're correct. But I mean, coming out of this period, I think we are going to see a surge in growth. However, I wouldn't bet on it being like sustainable beyond a year or two.
Well, I'm sorry, you won't be able to go to a restaurant anymore, but you will be able to go to Costco and get your hot dogs and your pizza there to take out. So I guess there's going to be long lines at Costco and Walmart and Target and all of them.
Yeah, I mean, consumption is the American dream, just buying a lot of stuff. And, sadly, it's the policies and the mismanagement of the pandemic. It's exacerbating the gap between the haves and the have-nots and the elites and everybody else, and, corporations and large businesses relative to small businesses. I mean, sadly, that's been the outcome. And it hasn't been, it's been unfair to many people, but, unfortunately, that's just how life is. It's just things aren't always fair, especially when the government's involved.
Hey, I'll tell you what my law school professor said first year. He said, fair is a sissy word. So when you're thinking about fair or unfair, just remember that. It's just life ain't fair. And that doesn't mean that you have to be either eat or be eaten or eat what you kill. It's just an understanding that that fairness is not the way that the system is currently operating. It's not there to make sure that justice is administered. It's not there to make sure that that you are able to feed your family if you're willing to work. I mean, it's a whole different set of interests, but we could get into that another time. I think we both agree there are some major challenges ahead, and that's why really you need to subscribe to Jordan's publication. I can't emphasize it enough, Jordan. We're really in uncharted territory. That's why you need the Daily Gold. Just go over to the dailygold.com. They can get your book there. How's that work, Jordan?
Yeah, you can just opt in there at the top of the site, and you can get a free copy of my book.
Absolutely. Absolutely must reading. I've read it, and I'm a big believer in a lot of what you have to say there, Jordan. And hey, the nice thing, about precious metals, they don't discriminate. There's no, it's like you buy the metal and that's it. Right? There's no agendas or anything else. Yes, people that sell metal are in business to make money, right? Bullion dealers. But that is like any business. You buy your gold, you put it away someplace, preferably not in your home. Never a good idea to have it there. And then you kind of sit back and wait. But one thing we didn't talk a lot about, but when I have you back next time, Jordan, we're going to mining stocks. So they've kind of leveled off. But it feels like they're getting ready for a breakout, probably after the first of the year, perhaps, or maybe even the last week of the year.
Well, I mean, it depends on what levels you're talking about. I think most, my view on the metals is pretty much the same as mining stocks, which is the corrective bottom is in. They're going to work their way back to those August 2020 highs. So that's what I'm looking at least for the first quarter and maybe partially second quarter.
All right. And I'm kind of agreeing with you there. Remember last March, remember what happened to gold and silver. Silver was down to $12. Gold got hit, but not anywhere near like silver, but it was like a nanosecond. It was under $12, and then it just headed straight back up, and the recovery in precious metals was so much more rapid and intense than the recovery back in 2008 and 9, when gold got slammed down to $680 and silver, I think, was down to $9 I bought it at $7 then. I think it was down at $7 and change. That took like 6 months for the prices to recover. This time, man, those prices just shot off. Like, it was amazing. The recovery was like in 4 or 5 weeks. Metal prices made new highs.
Yeah, it was the entire move was 4 months compared to, I think in 2009, before we had a correction, it was also a 4 or 5 month move. But in percentage terms, we moved materially more than we did this time around compared to 08, 09.
Mm-hmm. All right. Well, lots more interesting stuff ahead. Make sure you go check out Jordan's site, thedailygold.com. Get his free book. It's must reading if you're into this sector. And if you're not into this sector, you really should consider it, because it might be the only sector of the Western economies that really outperforms over the next several years, maybe the next decade. Who knows? Nobody knows the future, but you certainly can get a glimpse. I'd like to hear from you. Get your thoughts on where you think we're at. And that would mean you send me an email to kl@kerrylutz.com. Jordan, always a pleasure. And by the way, visit the website, financialsurvivalnetwork.com, and sign up for your free newsletter. Jordan, we'll talk to you again after the first of the year. Merry Christmas, Happy New Year, and all that good stuff.
Thank you, Kerry. I wish you and your listeners all the same, and look forward to speaking with you again in the new year.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now. more than ever.